By the way,
Charles Payne, and this is Making Money. Live from the Money Show conference right here in Orlando. Think about this for a moment. 3 years ago today, on this day, a panel of economists, world-esteemed economists, were unanimous. Their assessment was the United States was on an unavoidable path to a recession within the next year. So instead, what happened? We came into this week celebrating the third year of a massive monster bull rally. I call it the Chat GPT rally. Of course, these days, it's not the economists who are worried, but the Wall Street mavens who really, they're nonstop belly aching over concentration of the markets, lending risk in AI, all of that stuff. It's kind of amazing because, really ironic, the real danger in the market this week comes from the financial community. Regional banks under a lot more scrutiny. We've seen some really ugly things. This, of course, after last week, we found out Jefferies admitted they had exposure to First Brands. And now, again, 2 regional banks reporting fraudulent loans yesterday. So for now, the market's on hold. The VIX, it's paused, but it's made a parabolic move. And there's no doubt anxiety remains pretty thick in the air. So we're lucky to bring on Allianz Chief Economic Advisor, Mohamed El-Erian. And Mohamed, you know, right now there are overwhelming number of crises. There's a lending crisis, a liquidity crisis, and obviously there's a trust crisis. And I'm curious, because you've seen it all, how do you measure the current circumstances on the ground versus the sort of PTSD that a lot of people on Wall Street have?
So thanks for having me, Charles. I think you have to start with the key issue, which is the economy is sound, and we're in the midst of an AI-led process that is promising us future productivity gains. Add to that deregulation, and we're in a good place. Having said that, there have been pockets of excesses in the financial system, and we discovered some this week. They're not systemic, so they don't threaten the system as in 2008, but there are pockets of excesses, and you get that when you have a major transformation going on.
So with that in mind, maybe that's why the market's kind of cooling down a little bit today. There are other issues out there as well. The Beige Book doesn't get a lot of press, but it certainly seemed to confirm that Powell made the right move when he started to pivot to the labor crisis. My concern, though, are, look at Indeed, for instance, their data and other data. What are the chances that the Federal Reserve is so far behind that when they finally catch up on the data, they have to start cutting by 50 basis points?
So first, as you know, I think they are behind. I think they should have started cutting in July. The Beige Book showed that the employment side is a problem. This low fire, low hire economy with companies starting to be more willing to let people go. So we've got to be really careful. Powell's problem is that he's worried about inflation, but with the credit issues that we've had this week, I think it's almost a done deal that we're going to see another 25 basis point cut at the next Fed meeting.
I'm curious as to the Myron effect, if there is one yet. Certainly, some are saying because he's pushing so hard for 50 basis points publicly and obviously behind closed doors at the Fed, that it's going to kind of create sort of a pressure on the next Fed chair, who may, ironically, not be Waller, who was sort of in the lead until Myron came on the scene.
Yeah, and what Governor Myron is doing is 2 things. One is he is acting as a catalyst for the Fed to talk about things the Fed should be talking about. They should have had a conversation last time. Should we do 50 because we missed July, or should we stick to 25? So his first effect, which is important, is he's putting issues on the table. The second one is he's getting certain other Fed officials to talk about reforms to the Fed. And I think that is really important. The Fed has been very slow in modernizing itself, in self-disrupting itself. And when you have an outsider come in, like Governor Myron, he creates a catalyst for a discussion of reforms. And we've seen 4 Fed officials come out with 2 different proposals to modernize the way the Fed approaches monetary policy. And as you know, Charles, I think that that's long overdue.
Right. Now, you've actually been outspoken about that. I've been bringing up the notion of jobless prosperity, for lack of a better term. I remember the jobless recovery. And the reason I bring this up is we just talked about the labor market. obviously being under some pressure here. And yet with AI obviously taking some jobs, how many we don't know just yet. There's prosperity on one side, it's the old K-shaped thing, but is it oxymoronic? I mean, how do we deal with the inevitability that what we see now with the folks who are doing well, like if you look at American Express's earnings, for example, versus those who aren't and those who are going to lose their jobs? Can a nation exist under that circumstance?
And you're right to worry about them. We're seeing two types of decoupling. One is GDP growth from employment. So as much as people are talking about a weak labor market, let's not forget that second quarter growth at 3.8 was the highest in 2 years. Let's not forget that the Atlanta Fed suggested that we may have grown at 3% in the third quarter. So we have strong growth and yet a weak labor market. So the decoupling of GDP growth from employment is something to keep an eye on. The second thing, you're absolutely right. There's a decoupling of middle and high income households from low income households. And that is not a good thing. So we've got to keep an eye on both. We don't know whether this is simply a temporary effect or whether it's something that is more sustainable. But like you, I worry about both these effects.
Mohamed, we've got just a minute and a half to go, and I appreciate all the time you give us. The debasement trade or worry, has that come and gone already?
Where you see it is in two things. One is in gold, which has gone from record level to record level. And remember, gold is your risk-off asset, and its records have happened at the same time as equities risk-on have been record level. I'm not too worried about that. The second place you see it is in the willingness of foreign investors to invest heavily in the US, but hedge the dollar. And that is something we got to keep an eye on because the dollar is a reserve currency. It brings a lot of benefits to the US, and we've got to keep an eye. So there is no doubt that the rest of the world appreciates our economy. They're just less enthusiastic about the dollar than they used to be before. And that's why the dollar is the one major asset that hasn't bounced back since April.
Before I let you go, Trump and Xi, they're still going to meet. It's been my contention for the last week or so that all these headlines are sort of saber rattling, positioning before they meet face to face. How likely is it that maybe we do eventually get a deal sooner rather than later?
So I think we will get a deal. I think you're absolutely right. This is negotiation. This is every side reminding the other side that they're holding certain cards. I think the US cards are much stronger than the Chinese cards. And I think China will realize that. And I think you will get an agreement. But longer term, we have to face what I think is a reality, which is China and US tensions aren't going away. There's aspects of national security here that are going to be with us for a while.
Mohamed, thank you so much. It's always a pleasure to talk to you, particularly in a day like today. Perfect timing. Have a great weekend.
You too, Charles. Thank you.